Whether you're a founder just starting out, a seasoned business owner looking to expand, or simply interested in learning about the world of business, this podcast is for you. My name is Mario Schäfer, CEO at OneID. In each episode, we will explore topics related to the creation, growth, and globalization of businesses, from ideation and funding to marketing and operations. Our guests will share their insights, experiences, and lessons learned along the way. Join us as we dive into the world of entrepreneurship and business on this podcast. Please follow us on YouTube. I'm here today with Juan and Manuel from the MindCo. Happy to have you on our podcast. Could you tell us a little bit more about yourself?
Thank you, Mario, so much for having us today. It's really an honor to participate in your podcast. I'm Manuel Benitez. I'm joined here by my partner, Juan, and we are partners at the MindCo. We are a strategy and innovation firm, and we serve companies throughout the Americas and Europe.
Thank you very much, Mario. This is Juan Roberts talking. We devote to supporting companies in their growth processes, in their innovation processes, both being organic innovation processes and also inorganic. We are very happy to discuss this with you and see how we can support your audience with our experience.
Our topic today is a very interesting one: corporate entrepreneurship. What specific organizational structures or frameworks have you seen effectively support corporate entrepreneurship initiatives, and how do they differ from traditional hierarchical structures?
In my experience, I've seen maybe 4 types of organizations within corporations that support entrepreneurship. And the way a company chooses one or another type of organization, I guess, depends on the size of the price or the investment and the level of adjacency. So for large entrepreneurships that are very adjacent to a company's core capabilities, this would be typically handled by M&A and business development. This is a typical, I would say, hierarchical structure. Nevertheless, these teams sometimes function with their own rules, but I would say they fall into the typical hierarchical structure. When the size of the price or the investment is large, but it's further away from the core adjacencies, business development teams take more the lead in those type of ventures and entrepreneurship. I would say that many times for large deals and things that are impacting the strategy and financials of the company very heavily, these functions fall into the typical hierarchical structure. Nevertheless, the question is when we are discussing smaller opportunities or growing opportunities that may prove large in some years, but they are not nowadays. And in those settings is where companies struggle the most. Some companies have their own R&D teams, and this is true for many pharma companies and food companies and different sorts of companies. And I guess this is for maybe incremental opportunities, so closer to the core of the company. And that's why they dedicate resources to investigate new products and innovation. And when it's further away from the core, typically companies are selecting or choosing the corporate venture capital model. This model acknowledges the existence of an ecosystem of knowledge and of R&D as well outside of the corporation. And it's really useful. Of course, it works with an independent government structure many times because it needs to engage into a lot of partnership and leverage the innovation and knowledge that is happening outside of the organization to bring it into the organization. So all in all, we see these 4 options of organizational structures or frameworks that are working within corporations to foster an entrepreneur.
Yes, so adding a little bit to that, I think that what we have seen is that when we are pursuing opportunities that are further from the core of the company and are very innovative, but they're risky, such as startups or scale ups, different governance structure is key because the return on investment and the way that it's measured varies a lot compared to how hierarchical structures work within the corporations and companies. So if I would have to sum it up, I would say that there's a different mindset attached to that.
In your experience, what role do internal incubators, accelerators, or innovation labs play in driving corporate entrepreneurship? And what are some best practices for implementing and managing these programs?
Having in mind that the corporations need to develop a different mindset or a different structure for driving corporate entrepreneurship, internal incubators or accelerators or innovation labs are so what we have seen are very good success cases from different corporations that were able to drive these labs independently. For instance, Johnson and Johnson, a great pharma company, has the J Labs program that is an incubator for life sciences startups, and they provide entrepreneurs that they choose with access to facilities, to funding, to mentorship, but with different KPIs compared to their own internal structure. So they measured them differently, and there have been very successful startups from these labs. Unilever has a very similar program within food, within household goods. So there have been some very good opportunities that they pursued, and they're very good projects that they were able to achieve with these kind of structures. And in these cases, you asked about best practices. There are many best practices, and with the mantra of keeping the governance independent, one of the key things is having clear objectives. So the organization needs to know that these innovation labs have different objectives and that this could be long-term objectives. And the leadership, this is a second best practice, has to support these objectives and needs to sponsor this, although they are very likely not going to see results in the short term. And once they do this, the third best practice I would say is to provide dedicated resources and infrastructure in order to foster cross-functional collaborations. This could be some of the best practice that we have seen with the mantra of keeping things separate, but together with the corporative structure.
At the end of the day, these internal incubators, accelerators, or innovation labs allows an organization to get more breadth in the entrepreneurships they pursue and the investment they make, more breadth, but also less commitment to each individual investments, because there's typically other investors and other people from outside the organization that are not only bringing their expertise, but also resources. And this is also some value add, some plus value that you get from these sort of organizations, that you can bring innovation from outside of the organization into the organization and learn from that. So learning is many times one of the key objectives, but it's very hard to cope with the very different financial model this organization has, because they are typically investing smaller amounts in a wider breadth of ideas or startups, or as Juan mentioned, scale-ups, and the payback will be very difficult to manage economically. So it's important that the other benefits are also clear, discussed, aligned, and supported by the leadership of the organization.
Interesting enough, whenever I met the MindCo, we have been working in a big multinational company looking for business opportunities. Related to that, how do companies effectively identify and prioritize opportunities, and what methodologies or tools do they use to evaluate the viability and potential impact of these opportunities, in your opinion?
There's commonalities and differences depending, and as we were discussing, on the type of setting that we are at. So if we are discussing an innovation lab, for example, that's looking to bring the company's forward-looking vision to life, we may be selecting where to invest based on the macro trend that they belong to. It could be the metaverse, it could be any forward-looking macro trend that it's a decision of a particular company to begin a journey within that. Another one could be cultural, for example, for this type of setting. You know that when you invest in startups, you invest in teams, their knowledge, and you know, what you believe is their capacity to succeed in a world that's flooded with startups. So that's another relevant variable when we're discussing an entrepreneurship and corporate innovation setting. Whenever we are looking at larger entrepreneurship, such as M&A, it already becomes much more financial in the evaluation, and also in terms of the difficulty that it may carry to make a merger after an acquisition.
Yes. So typically, Mario, what we have seen, as Manuel said, it depends a lot on the setting, and we can talk out for hours on this. But there are some key questions that we could ask. For example, is the innovation, is the objective of our lab to look for disruptive or incremental innovation? Are we looking to beat the competition by identifying key intellectual property? So there are some key quick questions that we can do and we can make. And there's a typical framework that may apply to all prioritization efforts within companies with caveats and differences. But first of all is, which is the pain point? So are we addressing a real pain point? Is this a real opportunity? Are we forward looking? So first of all, we need to have that clear. Second of all is understanding how and why is this project innovative and what it's going to support internally within our corporate strategy. Third of all is how advanced is this innovation? So are we talking about an MVP, a proof of concept? Are we talking about a dream? We can talk about a dream, but it has to be very much aligned with what we want to achieve. And finally, a kind of a strategic alignment assessment. So is this opportunity fitting within our corporate strategy? It's core, it's adjacent. Is there any risk of cannibalization? Are we ready for that risk? These are some key questions that everyone can ask themselves in order to gather the answers and guide us to see if these opportunities come.
Looking at examples of successful partnership models, can you discuss the role of partnerships, collaborations, and external ecosystem engagement in fostering corporate entrepreneurship?
Sure thing. Something that we internally discuss a lot at the Mindco is that there's no way that someone can innovate in this century without partnering. The model that we had last century that was internal innovation and keeping the intellectual rights internally, it's not working anymore. So the success stories that we are hearing from this century's last years, most of them rely on partnerships. So there are many examples that we can mention. I very much like the Merck example, that Merck's have an accelerator program that they actively collaborate with a lot of institutions around the world to quickly identify opportunities within healthcare and life sciences. For example, they collaborate with the University of Cambridge, University of Munich. They provide researchers and startups with funding. They work with accelerators, and it's all centralized within one strategy. So they are able to identify very different startups and opportunities and fund researchers. That's a great example. Without going forward to the food industry, for example, or the consumer goods industry, Unilever has a very strong program of accelerators such as Techstars and Collider. And they are also collaborating, Unilever and many companies, with venture capital firms. In this way, they can diversify the investment and also gather external knowledge and external validations. Many of our clients come to us, what they can do, how they can develop corporate venture capital firm or innovation lab. The first thing that we suggest is finding the right partners.
Not only on the operational side, meaning that these corporate ventures and accelerators are partnering, of course, with universities, think tanks, and different organizations generating knowledge outside of corporate world, but also with other stakeholders such as cities, such as other co-investors. It's very important to develop a network of co-investors that think alike, that have objectives that are similar to you, so that when you find a startup that you like an alliance with the objectives of your company and everything, you don't need to put all the capital yourself and allow for that risk to be redistributed with think alike minds.
Coming to the measurements of success, how do companies effectively measure the success of and the return over investment of their corporate entrepreneurship initiatives, considering both the short-term gains, of course, and long-term strategic impact?
Well, that's a tricky question. Return on investment is one of the key rules and corporate rules within most of our clients. Every time someone brings a project, they ask, well, which is the return on investment? How are we measuring it? And going back to the first questions that we discussed, the mindset is different for entrepreneurial innovation, for corporate entrepreneurship. So it's quite tricky how to measure return on investment in this kind of startups, in this kind of internal organizations, because the general corporative rules are not going to work. If we measure with the typical rules that we measure internal return on investment, maybe we will lose a lot of opportunities.
And this is mainly due to the capacity of projecting the benefit. Whenever we are discussing a business that we know because it's very adjacent to our core, it's easier to project and to understand how much we can make at the end of the line out of it. Nevertheless, when we are discussing many of these innovations that don't have a market nowadays, all of those estimations are less reliable as well, in a sense. So it's very important to couple our with other benefits that may be more intangible. For example, you were mentioning opening a new channel for a company, maybe a breakthrough, not only financial, but also capacity driven, the benefits that you gain out of it.
Going back to this mindset of measuring things differently, I think this could be one of the conclusions of this conversation. There are different KPIs that we can take a look at. For example, is this corporate entrepreneurship going to expand my market, improve my brand perception, differentiate my products? So is it going to increase customer satisfaction in some way or reflect value created for customers? All these things, for example, if I file patents, if there is an image of us being innovators. So there are different measurements and KPIs that complement the ROI and support the decision of go, no go with an internal opportunity compared to solely financial metrics.
In corporate entrepreneurship, finally, we create a different business unit. How do companies navigate intellectual property issues, talent retention challenges, and of course, also potential conflicts with existing business units or strategies?
Definitely. When it comes to corporate entrepreneurship, challenges such as IP issues, keeping talented folks on board and dealing with clashes arise often. And balancing between protecting what's yours and letting innovation flourish is like walking on a tightrope, right? Sometimes too many protection can stifle creativity. So it's really about finding that sweet spot where innovation can thrive without being held back. And corporate entrepreneurship steps in as a handy tool here, encouraging executives to get involved with startup boards, forming new teams, fostering an innovation-friendly environment through internal competition can all raise the wheels of progress, we believe. But of course, a conflict with current strategies can sometimes throw a curveball into that work, and companies need a clear strategies that mesh well with their innovation efforts. For instance, if there's a big disruption on the horizon, it might be the time for strategic move like spinning off a disruptive unit. So you need to accompany pace of change of that entrepreneurship with corporate adjustments and re-strategizing regarding that unit that is carrying forward the innovation.
Building up onto that, Mario, I don't want to sound repetitive, but there are some commonalities and common lines within the answers that we have been discussing, and this conversation is that sometimes the corporate suit as a structure for this kind of entrepreneurship or innovation labs or internal accelerators, it's going to be too tight to let disruptive innovation flourish. Thinking of separate structures with a different set of rules, with a different steering committee, they don't have to be flexible rules, but they have to be different rules, because these kind of aligned rules, and there have been a lot of success cases in the past, are going to make innovation more flexible and are going to avoid a lot of internal conflict and how we measure if we are compliant or not, because there are different things that we are doing within our corporations.
And let's not forget about the money side of things. Capital demands and cash flow can make or break innovation initiatives, and it's fine that it does. The point is to maintaining an agile mentality to be able to adapt to what is needed the most.
Thank you for this nice conversation about innovation and entrepreneurship today, Juan and Manuel.
Well, thank you very much, Mario. It's always a pleasure to talk to you.
Thank you, Mario, for the invitation, and thank you to your audience.